I'm Grant Walker. Welcome to Last Call for Monday the 25th of May. I'll be back with Heads Up Tuesday, 10 a.m. And now an Alloway update. Former Allied Farmers boss Rob Alloway has lost a bid to seek freezing orders over an alleged $120,000 in relationship property he says should be his. In March, a judge allowed Mr Alloway to continue his High Court fight for various assets he says he gave to his former fiancée Jane Bond. The former partners, who broke up about 2 years ago, have 2 young children together. Last week, before Justice Kit Toogood in the High Court at Auckland, Mr Alloway, who's representing himself, sought freezing orders over various luxury watches, a pair of diamond earrings, furniture and chattels valued at about $55,000, an iPhone, an iPad and 2 Louis Vuitton bags. Also included is an engagement ring valued at about $45,000, although Ms Bond has since sold it. On Friday, however, Justice Toogood dismissed Mr Alloway's application. Mr Alloway's case in short was that Ms Bond cannot be trusted and he wants the court to protect the assets he claims are his. His claim was under a rarely used piece of legislation, the Domestic Actions Act. That law relates especially to broken engagements and broadly says that if an engagement is broken, parties must return to their original position, meaning gifts must be returned. He said during the hearing, I'm sort of stuck in this position when 2.5 years on I'm trying to locate various property and I don't even have a fridge in my kitchen. But Ms Bond wanted to transfer the proceedings to the family court, or at least the district court, saying it simply was not complex enough to warrant a High Court hearing. Her lawyer, Moira McNabb, said her client is on a benefit and wants the lower costs and efficiency of the family court. Justice Toogood, in a judgment obtained by NBR Online, ruled in Ms Bond's favour, transferring the Domestic Action Act claim to the family court and other claims to the district court. The judgment says they are certainly not matters which should occupy the time and resources of this court. Justice Toogood says Ms Bond is entitled to costs on the face of it because she succeeded in her application for transfer, and Mr Alloway failed in his application for freezing orders and security for costs. Any application for costs needs to be made by June 12, Justice Toogood says. Mr Alloway and Ms Bond have concurrent proceedings in the family court. In that case, they disagree over whether they were together for the requisite 3 years to trigger relationship property rules. In business news, details of borrowing by Graham Hart's Rank Group from global investment bank Credit Suisse will be on the agenda for investors when Carter Holt Harvey comes to market. Credit Suisse has a long and deep relationship with Mr Hart and is a joint lead manager of Carter Holt's forthcoming initial public offer. Company's office documents suggest the bank is also a lender to both Carter Holt and its owner Rank Group. A securities register filing implies Rank's debt to Credit Suisse matures on September 15. With some proceeds from Carter Holt's IPO likely earmarked for debt repayment, Credit Suisse's direct interest in the deal is reminding investors of carpet maker Feltex, which was sold by a Credit Suisse private equity fund in 2004. Feltex collapsed into receivership in 2006. Institutional investors are tight-lipped after signing confidentiality agreements over Carter Holt, but several say they expect to see full disclosure of the Credit Suisse position. One investor said Credit Suisse would argue there are appropriate Chinese walls in place, so there is no influence. Our opinion is those things should be disclosed so investors can make their own decision. It's always best when you don't have those conflicts of interest. We consider it very important to see where incentives lie. The FMA says it expects companies involved in promoting securities offers to have effective controls to manage potential conflicts of interest. The FMA's Director of Primary Markets, Simone Robbers, says the role of a lead manager in an IPO is to help the issuer assess the marketability of their company and advise them on preparing their business for listing. There is no reason why a firm that's a creditor can't carry out the role of lead manager, so long as any material exposure is disclosed by the issuing company. She said the process of the IPO should ensure that full disclosure of all material information is made by the issuer, which means that while Credit Suisse may already have access to information about the company due to its existing commercial relationship with the company, if it is material information, it will need to be disclosed. The issuer's obligation to disclose material information includes disclosure of material information about its debt and creditors. Credit Suisse declined to comment on its interests in Rank Group. Carter Holt confirmed its IPO plans on May 12, saying it aimed to list on the New Zealand and Australian stock exchanges. It said Rank Group would retain a significant stake. A prospectus is expected next month for a likely listing in July. The joint lead managers of the offer are Credit Suisse, First New Zealand Capital, Deutsche Bank, Deutsche Craigs and Forsyth Barr.
NBR Radio, Monday the 25th, I'm John Stewart. New annuities provider Retirement Income Group, which was founded by the former AXA and ACC Chief Executive Ralph Stewart, has closed its equity crowdfunding campaign overfunded. I'm joined by Khalida Smiley, who's been covering that story. Khalida, how much did they raise?
The company raised $455,300 during their campaign on equities, and that was above the minimum they were hoping to raise, which was $250,000.
Well, it was a pretty short campaign, wasn't it?
Yeah, they'd added it to a wholesale investor campaign, which raised more than $2.25 million.
Right.
And also the founders added in $2 million of new equity.
So you'd call that a reasonably healthy harvest?
I would say so, yes.
Yeah. So what are annuities, and why haven't we seen them in New Zealand recently? They certainly have been a thing of the past.
Well, annuities, they convert lump sum retirement payments, like you would get from KiwiSaver, into a fixed income stream for the rest of the time that person would live. And I think a lot of retirees are a bit worried about spending too much at once when they get these lump sums, or that they might blow it on the holidays. So that's why in the past they've been relatively popular. But in New Zealand, they've traditionally lacked inflation protection and were not liquid, and they had tax disincentives, so they've fallen off in popularity.
And who actually sold these annuities to the public?
Life insurance companies usually did.
Right. So why is Retirement Income Group different from previous annuities providers?
Yeah, well, the company was actually deliberately set up to take advantage of the KiwiSaver market. And Mr. Stewart has told me in the past that he started thinking about the savings decumulation issue while he was setting up the first KiwiSaver funds at AXA. But one problem with the traditional annuities is that they were taxed at the company rate rather than the individual investor rate. Right. But this new company, they've actually secured a binding tax ruling from the IRD last December, and that fixes this problem. And they've also allowed it so investors can take their money out at any point, and when they die, the balance will be paid to the investor's estate, whereas in the past, many traditional annuities would hold on to the remainder.
Right. So it'll be an interesting company to keep an eye on.
Yeah, I would say so, and it will also be interesting to see how the annuities market redevelops here over the next few years, while the KiwiSaver funds, there's a massive pool at the moment, and it's expected there's going to be about $40 billion exiting KiwiSaver in the next 15 years.
Really? Well, of course, we've got the baby boomers starting to retire now, don't
exactly.
we? Yeah. Okay, well, thank you very much for that insight into Retirement Income Group, Khalida.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
NBR Radio, Monday the 25th. I'm John Stewart. And I'm joined by Jason Walls from our newsroom and Chris Smith from CMC Markets. He's General Manager there. And we're talking market talk, currency today. So, Jason, first, the euro fell 3.5% last week. What were some of the factors which influenced this seemingly large weakening of the currency? 3.5's a lot.
It's a lot. Yeah. It's quite a dramatic fall. Well, is it? Is 3.5% a dramatic fall? You'd think from.
Yeah, it was.
Yeah.
Morning, Jason. Morning, John. 3.5% was something that's probably been expected for the last few weeks. We have seen the euro very strong. We have seen German treasuries certainly rallying over the last few weeks. But the euro's been holding up around 115 against the US dollar and against global currencies when really their economy is very weak across the board. They're rolling out QE. ECB's bond buying program is certainly in full swing. And what we saw last week, we saw the ECB make some comments around front-loading some of their bond buying before the summer period.
That's right. They were changing up some of the times around that, from was it May and June?
Yeah, it was. So before
Yeah.
summer period where liquidity is a bit weaker, we're going to see them continually buying bonds at the same level, if not higher, than what they're currently doing. And what that shows to the market, it shows that there's flexibility in the ECB program. It shows that there's no sign of it slowing down at all. That certainly pushed the euro down to around 110 against the US. Most bank forecasts are still parity, even below parity by 2016-17 on the euro.
Okay, so that far away. Because that was one of the questions I was going to ask you a little bit later. It's like, do we see it happening before the end of the year? But
I mean, I think we can. I think it's already fallen so fast. What we're seeing, and we continue to see, is central banks devaluing their currency to try and drive export revenue. And the euro, they want a weaker euro. They want the euro down to parity against the US. And now the US are now stepping into the so-called currency wars in their own way because it's damaging some of their export income. But we saw the IMF last week also really hammer France. We're kind of forgetting about France being the second biggest economy in the Eurozone with the whole Greece situation continuing. They've got
because I was going to bring that up before, actually, because Greece would be quite a big part in this conversation, wouldn't it, when it comes to do with the strength of the euro? I mean, there's almost every single week there's more negative news coming from Greece, isn't there? Yeah,
Greece has got a few more payments next week to the IMF. We also have huge payments due in July and June.
Are we holding our breaths for that money to be paid up?
Well, what happened last time is when they had the last payments that were due, and it was $750 million, and they didn't actually pay that. They just took that from the reserve,
the pension fund.
Yeah, and so it's just like essentially back to the same level. I mean, they've been doing things like slapping these 18% taxes on tourists. They've been raiding the pension funds, as you said, and it just doesn't look very hopeful for them to. I mean, they've got billions to repay, and if they can't even get to the 750 level, I mean, it's.
Well, they're really just raiding the piggy bank, aren't they?
They are. I mean, look, it's a country of 11 million people. Their GDP or tax revenues around 67 billion, I think, last year, or near that number, and their repayment terms are, there's a lot of austerity required. I mean, they're not a huge exporter of many products. It's more the contagion that Greece defaulting and leaving the Eurozone potentially would have on the market. Portugal, Spain's recovering a bit, but France is a real dire situation. Unemployment is the same level it was in 2007. It's around 11% unemployment.
So that was before the financial crisis as well. So
and the IMF's comments last week were that France, you need to start actually making some measures to drive your economic growth and unemployment. So, more concerns than just Greece.
Yeah.
On the other side of the Atlantic, the US dollar looks to be full steam ahead, Chris.
Yeah, certainly the highest we've seen in the last month. US dollar certainly had a big sell-off over the last 6 weeks, which is what the Fed wanted. The Fed started commenting on the US dollar being too strong. That really hurt US GDP. But higher US dollar is going to happen.
Surely around the rate hike coming up, right?
Yeah, I'm certainly a dollar bull, and we closed at 96 on the dollar index on Friday night. We did go as high as 110 last year, but the US dollar story has to continue when you've got the Bank of Japan, the Bank of England, the ECB, certainly continually doing their quantitative easing. Dollar index, certainly rallied across the board last week. We saw the Kiwi dollar lower against the US dollar, the Australian dollar, the euro, as we just spoke about. Janet Yellen did speak on Friday, which kind of caused a bit of a rally. We also had higher CPI number. Inflation came in a bit better than expected.
Because she said something about the rate hike at the end of this year, right? I only briefly saw the story at the top. I was reading it as I came in, but she actually sort of a little bit of optimism of when it's going to happen, right?
Yeah, she's still leaving this September on the table and this year. I mean, June seems like it's certainly off the table in terms of a rate hike in the US. They're not there yet, was her comment around employment and some of the employment data, but Janet Yellen mentioned a rate rise at some point this year would be appropriate. It's so divided. The Fed is so divided. Every week we see more Fed officials speaking. Some of them are very dovish still on the economy. Inflation is still next to zero, which is delaying the rate hike.
But they did have some good news around inflation this week, though.
Yeah, they did. Core inflation was better than expected.
And unemployment?
Yeah, unemployment, it is getting better and better. The job creation is growing, but participation rate is at 40-year low levels, which means more people are on food stamps, more people aren't looking for jobs. So it's a real mixed picture in the US. But I'm certainly in the camp of a rate rise needs to happen. I would be happy to see it happen in June, because what's going to probably happen is they're going to have to raise rates much faster and much more rapidly than a gradual slow appreciation in interest rates. I mean, 0.25 rate rises is hardly anything that's going to really stamp down growth, I think.
So maybe
in the
0.5% or even higher than that?
Well, I think if they don't go in June or September, they're going to potentially have to go up in much higher moves.
Now, GDP growth estimates are due out this week from both the UK and the US. What are the expectations around these, Jason?
See, I read this and I was sort of a bit, with the UK especially, because didn't their first quarter GDP growth, that was a bit slower than what we would have liked, right?
Yeah,
Sorry,
well,
UK, not US.
Yes, so the UK, this week we're expecting a slight revision to 0.3% growth they saw in the first quarter. They had relatively solid Q1 performance. So did Europe, actually. Europe grew 0.4%, which was actually quite a strong result for Europe in Q1, the strongest since 2011. The US had a dismal Q1, as we all know. They had port disruptions, they had weather-related issues, they had a stronger US dollar. They also have the huge unwind in US energy companies pulling back on capex, pulling back on investment. But they came in at 0.2% growth in the first quarter, which was dismal. And now this week, what economists and analysts are forecasting is for a revision to show the economy contracted maybe 0.9 to 1% in Q1. What's interesting is US GDP, they revise it twice. Into June we'll get another revision, but a lot of hope is on Q2.
Just looking at GDP in the UK, I see Joseph Stiglitz is on record as saying GDP per capita in the UK is lower than it was before the crisis. I presume he means the GFC. That's not a success, he says. Your comment on that, Chris?
Look, I think inflation being as low as it is, I mean, marginally above zero in most of these major economies is really making it hard to drive GDP growth.
Yeah.
Oil being down, over 50% is certainly making it hard also. The fact that the Conservatives have got back in the UK is certainly a positive thing for the equity market. Still, the FTSE's at record high levels. The pound had a really strong week last week, certainly against the Kiwi off
47, was it?
Yeah, off 6%. So for New Zealand investors having offshore exposure, it's certainly been a good thing that the pound and the US dollar are strengthening. But UK economy, from what I'm hearing, and the fact that the Conservatives and that stability is back in, is certainly going to. You'll probably see some more growth there. But oil being where it is certainly keeping inflation next to zero, and that's a big concern for central banks.
Yeah.
The big financial story from last week was the 5 banks, and huge banks they are, which were fined close to $6 billion. What's your take on that?
Yeah, because we were talking a bit about that on Friday, weren't we? So $6 billion, and it was these people, the cartel, if I remember correctly, right?
Yeah. I mean, this has been going on since June 2013. It's been an investigation that's the FCA kicked off in the UK back in October, made the release that they were working with the banks. I mean, I'm not surprised. It's quite complicated. It looks terrible on the face of it that these banks had been manipulating prices for their own benefit. There could be huge civil lawsuits placed against these banks from big corporations that have lost out on worse rates than they should have been receiving from these banks. $6 billion in fines, the biggest fine for Barclays, like in Britain ever. Terrible for the industry because the FX market relies on these major banks to create the pricing and liquidity. It's not a central exchange like a stock market. You're very reliant on these major banks being a fair place to do business and create prices that the world effectively trades on globally. That it's concerning, but I'm sure the banks have made a lot more than the $6 billion in fines over how long they've been doing this. And there's lack of criminal convictions. A few traders are being fired, but what's surprising, and from the GFC, is the lack of criminal convictions across all of these fines.
Now, just finally and very briefly, Jason, what can we expect to be seeing in the week ahead?
Oh, well, I'll throw that one to you, Chris, actually.
Yeah, I think locally, Frontiera on Wednesday, if it comes out on Wednesday, the forecast for the upcoming season is a major event for our local market. We've got some key earnings out from local companies. We saw Contact today doing a special dividend, but
we've got something coming up online about that as well, so we'll have...
Right. Good.
Yeah.
We will watch with interest. Gentlemen, thank you both very much.
Thanks, John.
Cool.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In business news, Evolve Education Group, the childcare operator that listed in December, reported a smaller annual loss than forecast in its offer document as it settled a series of acquisitions faster than anticipated, driving higher revenue. The Auckland-based company reported a net loss of $8.1 million or 12.9 cents a share in the period May 20, 2014 to March 31st, 2015, smaller than the $9.5 million forecast in its November prospectus. Underlying earnings before interest, tax, depreciation and amortisation of $1.8 million were more than twice the $816,000 forecast, while revenue of $32.9 million was 14% above forecast. Chief Executive Alan Wham said in a statement the result was driven by accelerated settlement of acquisitions and improved operational performance at the ECE, or Early Childhood Education Centres. Key metrics of occupancy and wages to revenue improved versus forecast. Evolve completed 86 ECE centres in the period, one more than forecast, and has since bought another 8 centres and has 4 more under contract. The company raised $132.3 million in its December IPO to fund a series of acquisitions, including Lollipops Educare, the in-home child Pulse Group, Wellington-based iKids and Christchurch-based Artemis Learning. Chairwoman Nora Barlow, formerly the chief executive of retirement village operator Somerset Holdings, said the company is on track to meet guidance for 2016, including its planned dividend intentions. The prospectus forecast profit $16.6 million in the year ending March 31st, 2016, on sales of $136 million, an interim dividend payment of $4.6 million, and paying 50% of net profit in the 2016 financial year. Evolve said it's investigating new centre developments and has enough headroom in its banking facility to pay for acquisitions. The company posted an operational cash flow of $2.5 million in the period and held cash and equivalents of $4.6 million as at March 31st, with $90 million of bank debt undrawn. The shares last traded at $1, unchanged from the IPO price. So let's talk crowdfunding. The equity crowdfunding campaign for new annuities provider Retirement Income Group is closed oversubscribed, with management indicating extra wholesale investors will jump on board too. The company, co-founded by former AXA and ACC chief executive Ralph Stewart, raised $455,300 during a short-term campaign on crowdfunding platform Equitize, after hoping to raise a minimum of $250,000. The crowdfunding formed part of a wholesale investor capital raise that raised more than $2.25 million, plus $2 million of new equity from the founders. Mr. Stewart says 2 more wholesale investors want to participate at a material level and will confirm commitment this week. If either of these investors proceed, the company expects to reach a maximum funding target of $3 million, Mr. Stewart says. There have been no New Zealand providers of annuities which convert lump sum retirement payments into a fixed income stream for as long as a person lives, and are typically sold by life insurance companies for a number of years after falling out of favour due to their lack of inflation protection, illiquidity and tax disincentives. Retirement Income Group is taking advantage of the decumulation market heating up as KiwiSaver members hit 65 when they can withdraw their funds. The company's flagship annuities-type balance fund product, called the Lifetime Income Fund, will target retirees who want a steady income stream instead of a lump sum when they draw down their savings. The fund has been designed to overcome previous problems with annuities. The fund is awaiting the final stamp of approval from the Reserve Bank, which had to introduce new solvency standards for variable annuities to cover it. This is the first product of its kind in New Zealand, although they are popular overseas, particularly in North America and Japan. New Zealanders have started to accumulate substantial amounts of capital since KiwiSaver began 7 years ago, and the 500,000 people reaching 65 over the next 15 years will do so with savings of $36 billion. While individual balances vary, just over half of these 500,000 have incomes of more than $80,000 a year and have been KiwiSaver members since the savings scheme began in 2007. Retirement Income Group expects to seek a further $3 million of institutional funding in 2017, although it says the exact amount will be determined by how much is raised in this funding round and growth over the next 3 years.
NBR Radio, Monday the 25th. I'm John Stewart. Contact Energy is planning to return $367 million to shareholders. Jenny Ruth has been covering that story for NBR Online. Jenny, why are they doing this?
Well, Contact's come to the end of a number of years of fairly hefty investment in assets, and it doesn't have anything left on its plate, but it's generating lots and lots of cash, and it's pretty clear that it's got more cash than it will need. Back in February, before it announced its first half results, investors had been pretty sure that it was going to announce a return of capital. Instead, they dropped a real clanger on investors and said that they were looking at offshore investments, particularly in the geothermal area. While it's true that Contact's got geothermal expertise, investors were not at all happy with the idea of it going offshore, and they also were concerned that Contact might buy something from its major shareholder, Origin Energy, which is based in Australia and owns 52%. And investors definitely don't want that to happen.
This offshore investment, they were looking at places like Indonesia, weren't they?
Well, they didn't specify, but you look at the Pacific Ring of Fire where geothermal resources lie, and it doesn't take too much to work out where they'd be looking.
So is this $367 million handback, I guess you could call it, what shareholders have long been calling for, rather than money going into overseas?
Absolutely. They really don't think that Contact should be going offshore, and they definitely don't want it, the conflict of interest of it buying its major shareholders' assets. They really want the cash back. That's what they're investing for. A measure of just how shocked investors were and how unhappy they were. The shares had been trading at about $7.30 before this was announced in February, and they fell as low as $5.50, which is an awful way down. They were at $5.55 on Friday, and they've risen 15% today, which shows just how relieved investors are that now Contact is doing what they think it should be doing.
Well, if they had gone ahead with their offshore plans, it would have put a bit of a dent in investors' dividends, wouldn't it?
Well, that was also always a possibility. Contact's dividend policy was to pay out between 80 and 100% of earnings. It's changed that now to 100% of underlying earnings. It'll probably generate even more cash than that, so investors can look forward to buybacks. It would have, how much the dividend stream would have been affected, of course, would have been dependent on exactly what Contact planned to do offshore. And as the chief executive said this morning, any such investment would take longer than, say, 3 to 5 years to pay off, and investors just really aren't that patient.
Thanks very much for that, Jenny.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. An Alloway court update. Methven lifts profits. Trilogy triples profit. And we update the Contact announcement that's seen shares soar today. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. More results now. And NPT, the listed property investor, posted a 16% drop in annual profit, reflecting a bigger uplift in the year earlier period from a revaluation of properties. The Auckland-based company said in a statement net profit fell to $6.4 million or 3.94 cents per share in the 12 months ended March 31st from $7.6 million or 4.71 cents per share a year earlier. The latest earnings included a $1.2 million boost following a revaluation of its investment properties, lower than the $2.6 million gain booked a year earlier. Revenue increased 3.7% to $16.5 million. The retail, commercial and industrial property investor has been repositioning its portfolio to focus more on Auckland, the country's largest city. In the past year, its trading profit, which excludes one-time items, tax and unrealised changes in valuations, increased 16% to $6.96 million as it benefited from a full year's trading at its Roskell Retail Centre in Auckland, which it bought in October 2013 for $32.85 million. The company said NPT has balance sheet capacity for growth, and the company's focus will remain on acquisition of property where both sound cash flow and growth opportunities exist, adding it will sell properties when the value has been maximised and opportunities for acquisition are identified for growth. NPT will pay a 1.1 cents per share quarterly dividend on July 3, taking its total for the year to 3.5 cents per share, ahead of guidance for dividends to be in line with the previous year's 3.2 cents per share. The company said today it expects a minimum dividend of 3.5 cents per share for the 2016 year. Shares in NPT last traded at 65 cents and have gained 4.8% so far this year. In broadcasting news, Radio New Zealand has confirmed that it's asking some employees to reapply for jobs ahead of plans for more digital initiatives. The public broadcaster's head of content, Carol Hirschfeld, told NBR Radio she presented a change for proposal to staff 2 weeks ago. She says we're looking at a different alignment and focusing on our digital delivery. She says it's too early to say if anyone notable is leaving because nothing is set in stone yet. The broadcaster is currently advertising 5 new jobs on its website. They include a digital analyst, developer, homepage lead, digital journalists and a community engagement editor. Head of Digital, Glenn Scanlon, says these are new positions. However, Ms. Hirschfeld says overall employee numbers will stay neutral. Asked if it was a roundabout strategy to make way for digital specialists rather than traditional radio journalists, Ms. Hirschfeld says, I wouldn't frame it the way you have, and reiterated the calibre of the state-owned broadcaster's journalists. She hopes to have the realignment completed by the end of June. Meanwhile, a bill to update Radio New Zealand's charter has passed its second hearing in the House. Broadcasting Minister Amy Adams says the amendment will give Radio New Zealand a more flexible charter. In a release, she says the term commercial free is being added into the charter for the first time, and the bill will clarify that this applies to Radio New Zealand services while allowing Radio New Zealand to pursue new opportunities that do not detract from these services. This revised charter also gives the multimedia broadcaster the impetus to take advantage of the most effective means of delivery to reach its audiences. While there has been a decline in listenership across traditional platforms over the last 12 months, RNZ's online audience has grown significantly as their multimedia strategy is implemented. For the past 2 years, the broadcaster has received approximately $35 million in government funding.
NBR Radio, Monday the 25th. I'm John Stewart. John Forbes Nash Jr., the Princeton University mathematician who shared a Nobel Prize for Economics in 1994, was tragically killed with his wife in a car crash on Saturday. I'm joined now by Nathan Smith, who's written a story online about that death. Was Nash an important figure to the world, do you think, Nathan?
Oh, yes. He was larger than life for a lot of people, but his ideas and his theories that came out of that wonderful mind, also known as Beautiful from the movie, have spread far and wide through, especially American society, but ultimately Western society as well. He gave people the ideas that if you were treating people as rational human beings, you could potentially predict certain outcomes. And for a world full of chaos and anarchy, that was something new.
We certainly needed it. Now, how did those ideas spread from the esoteric world of pure mathematics into society at large, particularly with what came to be called his game theory?
Yeah, game theory was specifically useful for a lot of the policymakers and military leaders during the Cold War. As many of our readers may remember, the Cold War atmosphere was one of distrust and unsurety about exactly what the Soviets or the Americans would wish to do based on any provocations. And a lot of people at the top were worried about the fog of war. What can I expect? And his ideas pushed through the concept of, as I said before, rational human beings with the ideas of mutual self-interest, and eventually leading to some sort of calm, rational conclusion. And his equations brought that out. And from that, people have used, especially in psychiatry and in social science and even in politics, people have taken that basic concept that there is a way to predict people's behavior if you give them certain incentives or expect them to be self-interested, that you can rationalize and organize a larger society based on those ideas.
And I guess the theory of MAD, M-A-D, mutually assured destruction, sort of grew out of that that thinking by Nash?
That time period certainly brought that along to his own. It was a parallel idea.
Yeah.
But his basic concept of game theory, that you could get inside your opponent's head or your partner's head and effectively ask yourself what they wished, was based on an understanding of how humans operated.
Right. So are these ideas and theories of Nash's still relevant today?
I think that they've moved from being associated with maybe just the Cold War powers to something that has structured, especially the conservative sector of politics, showing that you could actually organise people around these ideas, and there has been legacies of that have come through other thinkers in the mid part of the 20th century as well. Friedrich von Hayek, for instance, they're all thinking of the concept of liberalism based on human freedom, and through that freedom, how can you push people in certain directions? So it was all about, ultimately, his ideas weren't just mathematics; they were about humans and how we operate.
And I guess that has relevance to our listeners who are in the business world, particularly where they're competing against each other.
Yes, even in the business world, mathematics is something that you shouldn't be afraid of. It's almost a language, and if you can't speak it, you're probably going to be behind.
Nathan, thanks very much.
NBR Radio with the Property Press. It's out now to show you around.
NBR Radio, Monday the 25th. I'm John Stewart, and I'm joined by our political editor who's up here in Auckland today from Wellington, Rob Hosking. Now, Rob will be looking at the week ahead, but also, I guess, we've got to look back a little bit to last week's budget. What sort of fallout do you think we can expect from that for this week, Rob?
Well, we're already seeing it to some degree. I think there's a bit of a feeling that the Muldoonist label has been raised. I think to some degree that's exaggerated, but there were a number of tinkering with taxes. The departure tax is a classic Muldoon move.
It is.
And there's been a number of other tinkering around those sorts of things, which and starting to annoy a few people. There's the telecommunications levy as well, and there's, I suspect, as this week goes on, ministers are fanning out around the country, particularly around Auckland, I have to say, discussing the budget and effectively selling the budget to mostly, but not exclusively, to business audiences. And I suspect that there might be a few fleas in ears as the week goes on.
What sort of fleas?
Oh, just a feeling that some of these levies are a bit unexpected and a little bit no new taxes and then these things. And I think the other thing is a lot of business people are concerned about the superannuation issue, and that's one that just cuts across every sector, really, that concern. And the government is
What
still...
sort of concern?
Oh, just that the government is, National's attitude to superannuation is effectively, what me worry. And that she's apples and nobody needs to do anything about it, when pretty much everyone who looks at the demographics and can draw lines and can add up is saying, well, no, you need to make some changes now. And National is frightened of its own shadow to a degree here because of what happened in the 90s. What annoys me is I think they've really drawn the wrong lessons from that, because really the political damage was caused then, and it was to Labour back in the 80s, by saying, by springing surprises on people to something that really requires long-term planning. The lesson to me surely is not, don't change super. It is give people time to adjust when you can see a crisis coming before the crisis gets here. And that's something that's just not happening now, and it is quite irresponsible, I think.
Now, on the whole question of superannuation, Andrew Little appears to have perhaps put his foot in his mouth as regards the question of means testing super.
Well, the thing about this is, somebody once said that a gaffe in politics is when a politician accidentally tells the truth. And that's effectively what he did, to some degree anyway, partially, because he said, look, It's not sustainable in the current model. They've taken raising the age of entitlement off, which was their policy at the last election. Now, I think that's a mistake. I think, lifting the age, which is what pretty much every other country is doing, is the sensible thing to do. And you do it, you flag that it's going to happen, and so people can plan for it. The alternative, of course, is the means test, means or asset test. And he was asked about superannuation. He said, well, raising the age was unpopular, so we're not going to do it, but maybe we should means test. And, of course, that was going to get the headlines. That's a big deal.
Well, I mean, a politician tinkers with superannuation at his own peril, doesn't he, or she? Yes,
they do, but somebody has to, both sides, and again, so, basically in doing the U-turn within, an hour or two of his comments and saying, no, I didn't mean that. Yeah. Or what did he mean? I mean, it was pretty. I was present at that breakfast. It was a sponsored one between NBR and Grant Thornton, and it was pretty damn clear what he said. So really, it was a straight out, default position. Let's be just as responsible as National.
Was he shooting from the lip, though?
It was in response to a question.
Right,
but it actually wasn't a bad answer.
Mm. Well, I guess this coming week, I mean, he hasn't really had any comment to make since Friday, has he? Do you think he'll be coming out and trying to set the record straight and explain to us what he meant?
What worries me is that neither of the main parties seem to want to talk about this at all, and Labour was gearing up to have a go at National for its, putting its fingers in their ears and humming very loudly on the issue of super. And because of Little's comments on Friday, I think they're not going to want to go near that topic. And so there's going to be, it's very annoying that you're going to have the two main parties who are too scared to talk about this. And I suspect, unfortunately, that they just won't go there. And until Little's comments on Friday, they were very much going to go there this week, because that was a big attack on National in the wake of the budget, that they were just being not responsible enough and negligent and reckless, I think were the words Andrew Little used, and he's dead right there.
Yeah. You think they were being a bit reckless?
But, National, yes, by just basically saying, look, we're not going to look at raising the age of entitlement or doing anything about that increasing chunk of government spending that is going into superannuation. I think you do have to look at those longer-term issues and say, well, look, the better off, maybe we do need to means or asset test if practicable. Now, I've got some questions about the practicality of that. But, again, I come back to, one of the few Labour policies I thought was quite central at the last election was that raising the age. In fact, I think they should have probably gradually said they're going to move it to 70, which is what a lot of other countries are doing. But instead, now it's suddenly, we were burned, let's all run away from this. Well, that we've got that pension, which kicks in at 65, is now being paid to people for around 20% of their lifespan. It was never meant to do that.
Yeah. I guess, to be charitable, one could say that Andrew Little was trying to put these questions on the agenda for public discourse over the next year or two.
Oh, I think he was. And like I said, his first reaction, I think, whatever you think of the means test issue, I think was dead right. These things do need to be discussed. But, like I say, within a couple of hours of those comments, he's run away from them.
The Aussies have asset testing, don't they? But it kicks in at a fairly high level of income.
And they have compulsory super as well, of course.
Indeed. Yeah, they do. Now, just looking ahead to the Greens leadership, I think the party at large decides that this coming weekend.
Yes, that's right. They've had a bunch of regional roadshows with the four candidates.
Who are those candidates?
There's Kevin Haigh, who's understood to be the front runner. He's List MP based down West Coast. Has a very long-standing career in various activist causes going back to the late 1970s.
He's very green, isn't he?
He is. He's a very affable guy. He's, people find him right across politics very good to work with. I think that's led to some misconceptions that he's maybe not hugely left wing. He's a very committed left wing activist, but the way he conducts himself is quite moderate, if I can put it that way.
Who are the other three then?
There's James Shaw, who's Wellington-based List MP, who was very much a late entrant because he's only been in Parliament since last election, but who I gather is making quite a strong running. And then there's Gareth Hughes, who's been in Parliament for a while, and there's a fourth guy who's not in Parliament, whose name I can't recall. Sorry.
Right. Oh, well, let's rate his chances. Fairly low down the list. Well, it looks like we've got a reasonably interesting week ahead, and I'm sure there'll be more public discussion on those superannuation issues that Andrew Little has raised. Thanks very much for your week ahead, Rob.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
More results now. Trilogy International, the skincare products and scented candle maker, announced its first dividend after annual profit more than tripled on Australian sales growth and the first earnings from its Accoya candle brand. The Auckland-based company said in a statement profit rose to $4.5 million in the year ended March 31st from $1.1 million a year earlier. Sales increased 23% to $36.6 million. The board declared a 3.66 cents per share dividend. Chairman Jeff Ross said the ongoing dividend policy will be dependent on future growth and acquisition opportunities, but the board intended to keep the payout ratio between 45 and 55% of after-tax earnings. The result beats Trilogy's March forecast when it flagged profit would more than triple while sales would grow at least 18%. The company had already beaten expectations for first-half earnings when it reported in November, with strong Australian sales of its Accoya brand candles accounting for about 42% of revenue. Chief Executive Stephen Sinclair said both brands performed strongly and profitably during the period, in particular in the New Zealand and Australian markets, with Accoya moving into profitability for the first time. In Australia, the new distribution agreement for Trilogy with McPherson's Consumer Products helped to deliver very good results in that market, plus the Accoya brand grew strongly. Sales in Australia rose 38% to $18 million, making up half of its overall revenue. New Zealand sales increased 15% to $10.2 million. UK sales rose 7.8% to $2.4 million. US sales dropped 6.2% to $776,000. Trilogy shares rose 2.2% to 95 cents and have gained 29% since the start of the year. And now a Contact update. Contact Energy shares jumped as much as 15% after the company staged a complete about-face, saying it can't find any suitable investments and that it will return $367 million to shareholders. That will be by way of a special fully franked dividend of 50 cents per share. The electricity generator and retailer is also promising to return more cash in future in the form of share buybacks and to increase its regular dividends to 100% of net underlying earnings. The company shocked investors in February by announcing it was looking for geothermal investments offshore when investors had been expecting a capital return. They were also suspicious that Contact might buy assets from its 52% shareholder Australia-based Origin Energy. The shares were sold off immediately, losing about 10% of their value within a few days, and after peaking in February ahead of the announcement at $7.30, have fallen as low as $5.50. Today the shares rose as high as $6.38 from $5.55 on Friday, but don't look as if they'll return above $7 in a hurry. The company said in a statement, Contact has concluded that there are no material investment opportunities available at this time that would sufficiently reward shareholders and that the company can support increased distributions to shareholders. It also said it expects to have limited capital requirements in the near term. Salt Fund's Managing Director Paul Harrison says his firm, like most local fund managers, has had discussions with Contact's management informing it that they weren't comfortable with what was proposed in February. Mr. Harrison says, from our perspective, the opportunities offshore were limited and we were uncomfortable with the pretty real risks and the connections with the major shareholder Origin. He added in the past the minority shareholders haven't been particularly well supported by the independent director.
NBR Radio, Monday the 25th. I'm John Stewart. Former Allied Farmers boss Rob Allaway has lost a bid to seek freezing orders over an alleged $120,000 in relationship property he says should be his. The reporter covering that story is Hamish McNichol, and he joins me now. Hamish, what's all this about?
Well, yeah, the kitty mix was some quite interesting reading, basically, but this property that's in dispute, or that he sought freezing orders over, and he says is worth about $120,000, includes various luxury watches, a pair of diamond earrings, furniture and chattels valued at about $55,000, an iPhone, an iPad, 2 Louis Vuitton bags, and an engagement ring, which is valued at about $45,000, although that's since been sold.
What does Ms. Bond say the amount should be?
Not entirely sure, actually, to be honest, but basically, if she has to pay this back, then I'm sure she's going to dispute how much it's all worth.
Indeed, I'm sure she would.
Yeah.
So why is this all happening?
Well, basically, various assets that he gave to his former fiancée, Jane Bond, are at dispute here. They used to be together, and then they broke up about 2 years ago, and they have 2 young children together. Basically, he's saying that Miss Bond cannot be trusted, and he wants the court to protect the assets that he claims are his.
And what's Ms. Bond say?
Well, as part of these proceedings last week, she just said that she wants to transfer the proceedings to the family court, or at least the district court, because basically it's a relationship breakup, and it's not complex enough to warrant the costs and the time of being in the High Court. And her lawyer, Moira McNabb, is saying that her client's on a benefit and wants the lower costs and efficiency of the family court.
And what does the judgment say?
Well, Justice Kit Toogood released the judgment last Friday, but we got a copy of it today. And basically he's ruled in Miss Bond's favour, saying that one of the claims is going to be heard in the family court, and the other claims will be heard in the district court. And basically this line from the judgment sums it up. They are certainly not matters which should occupy the time and resources of this court.
Now, this litigation's being brought under the Domestic Actions Act. That's different from a marriage breakup, isn't it?
Yeah, it's quite a unique piece of legislation, actually, and not many people bring claims under it, but pretty much it's saying that when you are in a relationship and break up, then you have to go back to where you were at the start, so any gifts that you gave, you can claim back. So we're not entirely sure how that claim is going, but it's certainly not going to be heard in the High Court.
So what happens next?
Well, there is, specifically relating to this claim, is Justice Toogood indicated that because Miss Bond has won this part of it and the hearing's being transferred, then it certainly looks like costs should be awarded in her favour, but he's given them until the 12th of June to apply for those, and no doubt that they'll probably be appealed against. So that'll be interesting to see if anything does come of this, or if they just don't bother about it and wait for the main dispute.
Well, there could be an appeal, couldn't there, in light of the fact that Mr. Allaway is known for his litigious approach?
Yeah, I certainly don't think we've seen the last of this one.
No. Thanks very much for that, Hamish.
NBR Radio with Baileys, New Zealand's leading commercial real estate company.
To results, Methven, the NZX-listed tap and shower manufacturer and exporter, lifted annual profit 21% in line with guidance after the acquisition of a Chinese manufacturing plant widened margins. The Auckland-based company said in a statement profit rose to $5.69 million in the year ended March 31st from $4.71 million a year earlier. That was in line with its expectation for annual profit growth of between 15 to 25%. Sales slipped 0.4% to $96.3 million, while earnings before interest, tax, depreciation and amortisation rose 12% to $12.7 million. At balance date, the tap and shower maker's debt increased to $22.75 million from $14.5 million a year earlier, after it finalised the purchase of its Chinese manufacturer, Methven Heshan, formerly Invention Sanitary. At its annual meeting last June, Chief Executive David Banfield told shareholders that the Chinese acquisition would underpin Methven's profit growth and boost its competitiveness by securing supply and doubling margins. The company said debt levels were comfortably within its banking covenant limits. Methven said it was cautiously optimistic about the future and expects full-year profit growth of between 15 to 25%, with sales growth of 5% as it benefits from the China acquisition. It will also look to reduce debt. The company said it's changing its balance date to June 30 so it can more readily predict sales and income. In New Zealand, profit dropped 21% to $3.04 million as sales slipped 1.6% to $32.11 million. Methven said the performance was below expectation as a key customer further reduced its stock holdings in the final quarter. Across the Tasman, Methven increased profit from Australian operations 23% to $1.59 million, while sales rose 2.9% to $36 million. The company raised prices in Australia to offset the decline in the Australian dollar against the US currency. The company narrowed its loss in the UK market to $276,000 from a loss of $1.1 million a year earlier, as its sales increased 5.5% to $23.2 million. Profit in its China market increased 20% to $72,000, while expected revenue growth has not materialised, and sales slipped 3.5% to $385,000. The company closed its standalone Xiamen office, with back-office functions to be managed from its Methven Heshan operations. Methven also announced Peter Staines will end 11 years on the Methven board effective July 15, to be replaced by Nora Barlow, former chief executive of Somerset Holdings. Methven boss Banfield will also join the board as a director. The board declared a dividend of 4 cents a share. Shares of Methven rose 1.7% to $1.18 and have gained 2.6% since the start of the year. Let's talk local government. It appears an unlikely combination. For her latest endeavour, Rate Revolter and activist Penny Bright has found support from lawyer and former ACT MP Stephen Franks. The serial campaigner, Ms Bright, famed for her refusal to pay Auckland Council rates, has turned her attention to Wellington. The Windy City appears set for merger with surrounding local councils following a local government commission recommendation. In December last year, the commission recommended the establishment of one council with 8 local boards by November 2016. Ms Bright is calling for an inquiry into the local government commission's alleged failure to carry out proper due diligence when preparing reports on the Wellington Super City merger. Mr Frank supports her. In a letter obtained by NBR Radio, Mr Frank says his support for Ms Bright's proposal is not for a client. The lawyer had been employed by a group of Anti-Amalgamation Council's Local Democracy Coalition. The leader of that group, Ray Wallace, has made a separate submission. The letter says it is our distillation of concerns and recommendations from the last 2 years of working on the commission. Over time, it's become evidence that obvious mistakes were not isolated. We attribute it to a lack of competence or resources in the commission. The submission goes on to allege the commission that prepared the report showed obvious bias, used unsupported emotive language in reports when it should have been objective and research-based. The letter says the way local boards are described as false in advertising made by the Greater Wellington Regional Council and was found to be so by the Advertising Standards Authority. Parliament's Local Government and Environment Committee Chairman Scott Simpson says he cannot comment on the allegations, but says he's asked Mr Franks to appear before the committee to give further evidence. After that, the Local Government Commission can offer a response.
NBR Radio, Monday the 25th. I'm John Stewart. Details of borrowing by Graham Hart's Rank Group from global investment bank Credit Suisse will be on the agenda for investors when Carter Holt Harvey comes to market. Our reporter covering that story is Tim Hunter. Now, Tim, Feltex, the memory of Feltex has been invoked in discussion about Rank Group and Carter Holt Harvey. Why are investors reminded of Feltex in this particular scenario?
Yes, well, hopefully there's not a matter of the financial fragility of Feltex here, but the issue, as I understand it, is a potential conflict of interest, which some are seeing happening within this transaction. The basics of it are that Graham Hart, his company Rank Group, is selling Carter Holt Harvey to the public in an initial public offer, and that involves him selling down to a minority stake. But one of the things that we don't know much about at this stage is
the relationship of Credit Suisse and Graham Hart. Now, Credit Suisse, according to Companies Office documents, has a lending relationship to both Carter Holt Harvey and Rank Group, and this creates a potential conflict of interest in the sense that if Credit Suisse has got a large debt exposure to Rank Group, they will have an interest, presumably, in potentially lowering that debt exposure through selling, through the sale of equities in Carter Holt Harvey. And the other aspect is that in lending money to Rank Group, they might be party to some extra information which the public don't know about, who are potentially buying these shares. So it's not a deal breaker, of course, but the issue will be that investors will want to see any potential conflicts of interest properly disclosed when it comes to that. Now, the reason they're reminded of Feltex is that Credit Suisse has a very long-standing relationship to Graham Hart, and as an investment bank, they've been involved in a number of issues. And in the float of Feltex in 2004, there was a Credit Suisse private equity fund which was the vendor of Feltex to the public. And after Feltex collapsed, there were some grave concerns that the public weren't told all the nitty-gritty information about Feltex's financial position, and it led to some very long-standing legal action. And even now, people feel that perhaps they haven't really got to the bottom of that story. And so this isn't, the same as Feltex, but it's that sort of dual role as both the marketer of the IPO and having an interest in the deal itself that is what is reminding people of Feltex on this occasion.
So how much has Credit Suisse actually loaned to Hart's Rank Group?
Well, this is one of the issues we frankly don't know. The companies in the Rank Group are private, and Carter Holt Harvey is a private company and doesn't need to disclose its financials. And the exposure of Credit Suisse is another one of those things which is not known to the public at this stage. So it could be very small, it could be quite large. We simply don't know, and that's hopefully one of the things that we'll find out.
So when's it expected to come to market?
There are people in the market saying that we should see a prospectus perhaps towards the end of next month. Mm-hmm. These things do take time to dot the I's and cross the T's, and with a potential listing due in July. And it will be very closely watched because it's such a large offer coming into the market and obviously still a very significant business.
Tim, thanks very much for that.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.